Hey, it's Soleil, and this is episode 430 of the Orange Pill Investor. And today I want to talk about another, I guess, somewhat overlooked, and probably probably should be overlooked, ETF. Not financial advice, just one man's opinion. WNTR Winter. Jeff mentioned on the call last time, like he's seen some people talking about like 70-30 portfolios or whatever with Misty Winter. And the only thing that I really knew about Winter was that it was short, right? So you're betting it's going to make the most money when strategy goes down. So my first thought was not only no, but hell no. And the TLDR version is I at least for now, I think that is the my conclusion. But the other thing that I noticed was Jeff was like, "Hey, maybe you should do a deep dive on Misty and Winter." And I was like, "Yeah, that's a good idea." And then I realized I think he just Jedi mind tricked me. Like I quit my job in December, and now I'm getting like homework assignments from this guy. So he might be using the Force, and I think I got Jedi mind tricked into this one. Anyway, I'm gonna do a probably a whole ass True North Now episode on this, and I'll put a whole like slide deck together and really do a deep dive. But in that, while doing that research, I went through Winter's current trades. I did something similar for Misty and IMST a few days in a row. I probably won't do Winter more than like daily or anything. This might be a one and done kind of episode because I think I kind of understand what they're doing. And last night, of course, Jeff went live, and basically we put a nail in the coffin for what Bitcoin needed to be trading at in order to guarantee S&P 500 qualification, not necessarily inclusion, because the committee can still do whatever the committee wants to do. And now that I've got my hands on Jeff's spreadsheet, I might start trying to figure out how much Bitcoin and what Bitcoin's price needs to be for them to like actually get included as the number one company. I don't think it could happen unless they kick the can down the road several quarters. Just ballparking it, it probably still wouldn't even come close. But just as a thought experiment, like if we get some kind of, like a couple of people have been making the $1 million Bitcoin predictions, and I wonder if something along those lines might actually be enough. Especially if we get preferred ATM expansion, and if they can just have all of the ATMs running at the same time, the common, like if strategy runs up to 3 to 5 MNAV or something, they could run the common just without too much trouble. And if like Strike ran to like 120 or something, if Strife, Strike, and Stride are all pumping, Bitcoin's pumping, strategy's pumping, what would the Bitcoin accumulation numbers and Bitcoin values have to be in order to generate a market cap to put strategy at number one? I kind of figured Tesla and strategy would be the number one and number two companies in the S&P 500 in, let's say, like 2033 at the latest. Maybe a decent kind of a shot at 2029. 2029, we would be seeing tons of profits from Cybercab, but it might be much later before we see any like legit profits on Optimus. So could take a while. But anyway, let's check the chats real quick and then get to it. Emperor Sailor hitting the ATM. Yeah, they actually hit the common ATM, I believe, this past week to pay the dividends out on whatever got paid. I don't own any of the preferreds yet. I'm kind of banking on strategy hitting, I don't know, somewhere between $8.50 and $12.50 a share before I would consider like rebalancing into the preferreds. I know Dan said he trimmed a little bit of his strike position after it pumped. Oh, you can't get strike on Robinhood. Okay, so strike's still around 119. Strategy pumped to over 400. Now we're chilling back at 378, 379. But strike looks like strike went up and stayed up. And I think he rebalanced into stride a little bit, which was still trading pretty low, because I think you're getting the discount of it being new and not really whoever the hell was buying down here at 86 got like the bargain of the century, because there's no reason in hell why STRD can't be trading at strike levels 3-6 months into the future, and God knows what strike will be trading at that point. So yeah, that was kind of the point of the preferreds in the first place, is you only have to hit just enough of the common ATM to pay those dividends out. So you're basically delaying the pain of having to pay those dividends until inflation has taken its course and made that $8 per share worth a lot less than it is now. And I guess I might be making an argument against owning it, because you're just getting paid like a flat dollar per share. And we know that dollars will be worth not much in the future. But anyway, for fixed income people, this is kind of a no-brainer. And I think that's why Dan likes strike so much, is because it has the embedded call option. So he can get the guaranteed dividend without giving up all of the upside. And we were discussing it in the chat, and I thought, well, strike is kind of okay. So it has the embedded call option and it's paying a dividend. And if you set up a drip in strike, it's a call option that 4 times a year buys more call options. You get 2% at par call options buying more of itself. It's like a self-replicating call option. So that's kind of cool to think about. But yeah, the point is that if you have to hit the common ATM to pay the dividends, and the dividends is paying 8 to 10%, but Bitcoin's going up 30%, then the MSTR common stock shareholders are capturing the spread between the 10% and the 30% Bitcoin CAGR. If you don't think Bitcoin's going up, though, then the preferreds don't make any sense. What's up, Grit? Thanks for the deep dive and being mind tricked. I guess I didn't have a choice. Let's see. My mind is blown by the possibilities that Q3, Q4 will probably be better than Q2. Yeah. Yeah, let the front running begin. I don't see how it could be anything else. You see, you need some Emperor said telling me you need some preferreds. I sleep better at night holding these versus Misty. Yeah, I'm as soon as like December, January comes around and I can dump all of my Misty IMST, I will be glad to do so. But I took the covered call ETF challenge because I'm a gamer and I like PvP, right? So I like player versus player games. I like card games. I like board games. I like dice games. I like anything that is competitive. So I guess I'm extremely competitive, but not but only within the realm of sportsmanship. Like we played a lot of card games when I was a kid, and my dad's pretty good at them. And when he would teach me games like euchre or pitch, you know, when you're a kid and you can barely even hold like all your cards, um, you know, he would actually let me play with my cards like face up on the table, and then he would play his hand as if he didn't know what cards I had. He would play kind of like according to Hoyle, like you know, and he would even say things like, "Oh, okay, I see that you have the King of Hearts, but if I didn't know that you had the King of Hearts, I would lead this Queen of Hearts, blah blah blah." And so, I think I learned a little bit of intense kind of sportsmanship from that. So, even though I'm extremely competitive when it comes to games, it doesn't bother me to lose. Like I have fun no matter what. But I think you have to try as hard as you can. Otherwise, it kind of cheats the other person out of enjoying their victory. So sometimes people think, "Oh yeah, you're super competitive. You hate to lose." I'm like, "No, I'm super competitive. I hate to not try my best." I think that's kind of what it is. So even though my IRA is suffering slightly because I have it invested in Misty and IMST, it's underperforming my other accounts. It's still kind of fun. It's kind of worth it. Um, if it's providing any type of benefit, that's cool. But it's also kind of fun for me to set up a little bit of PvP. Uh, Brendan, what's up? What do you think about Dan Hillary's idea that Strike will trade in step with strategy until 6 to 700? I didn't see what he was saying about that. In step was until 600. So that's a 50% pump for strategy. So he's thinking that Strike will go up to 150, 180. And then what? And then Strike will kind of taper off because of interest rates. The interest rates like ratio to the to the dividends that that Strike's paying out, and then strategy will take off from there. I'm not really sure what the post said. I can't keep up with everything. I try like hell, but every once in a while I'll look and I'll be like, why does Tim have 10 fucking jobs? And I can't keep up with all of it. Emperor, he hit a lot more than just the dividend obligation. Volume must have been super juicy last week. Yeah, they might have been kind of looking at the end of Q2 and really wanting to like make sure make sure nothing happened with the Bitcoin price. Like absolutely, you know, he doesn't really talk about S&P 500 inclusion like they really like, oh yeah, we're really trying to game it. But you got to think that the guy that was getting his ass kicked by Microsoft for decades wants in the S&P 500 and doesn't just want to be in it, wants to fucking dominate it. So you've got a week left for Bitcoin to close above 95, 96. You pull all the levers. Not to say that they won't use the common ATM just to pay dividends or just to secure a Q2, quarter or whatever. I think it's all kind of a ratio. I'm not privy to whatever algorithm or formula they have, but I'm sure they're sitting there and he's got his engineer hat on and it's like, okay, if Strife, Strike, and Stride are trading at these ratios, then we can hit the common at this ratio. But yeah, I would like not to see any common ATM while the leverage is still so low. Like, strategy is sorely under leveraged. So every time they use the common ATM, a lot of people are pissed off, like, oh, he's pushing down the price. I don't really care about that as much because it's all accretive. So that doesn't bother me. I just don't want them delevering an already under leveraged play. Because the next time we get a move on Bitcoin to 150, I want strategy levered to like 20%. I think they're at like, I don't know, it was like 10% or something. The last time I shared Jeff's spreadsheet, we go over the leverage ratios and they're way under. They could have a ton more leverage. So the preferreds are not as mature as they could be yet. Once that gets ramped up, I want to see them just hammering that and just sprinkling in the common as little as humanly possible until that leverage ratio gets up to between 20 and 30, which is, I think, what their target was. I think that leverage ratio will inject more implied vol into the situation. So yeah, I'm not saying it's the end of common ATM usage and they're only going to do it for preferreds, but I think they'll be more judicious with it, and hopefully I won't see a lot of it until the leverage ratio is much higher. Now the flip side to that though is if they are trying to game their inclusion rank for the S&P 500, the more that they hammer the common ATM, the more shares they're going to have, which is going to basically smoke and mirrors artificially inflate their market cap. And then the higher their market cap weighting, the more passive inflows they're going to get. So there is kind of a backdoor accretiveness to the common ATM if you're willing to have a low time preference and suffer through some of the common ATM just to get a gigantic ass market cap in the S&P 500. So that could work out to strategy's benefit in the long run as well. BTC Pikachu, what's up? Thoughts on CRCL and hood calls? I bought and sold one hood 90 November call yesterday, which paid for a nice fancy lunch for two. I'll take a look at that later if we have time. I'm not. I think I looked at CRCL. It might have been you that mentioned it before, and I haven't traded hood calls in quite a while. But I'm sure the implied vol in hood is still pretty decent. Brandishing, then diminishing returns. I didn't fully grasp it. He had a wild 3-day graph using credit spreads and strategy price. Really didn't get my head around it. Thanks, though, man. Love your stuff. Appreciate it. Credit spreads. Yeah. So as an option seller, whenever I hear credit spread, I just think, oh, okay, a bull spread, bear spread. But he's talking about like the credit spreads based compared to the what is it? Is it the risk-free rate or the Fed funds rate? I can't remember. But yeah, those guys are going to be able to explain their own stuff better than I will. All right, so here's the spreadsheet. You just go to Yield Max, you go to their fund, and there's going to be a download button for all their positions. They'd also have an intra-trade position spreadsheet. I haven't looked at that too much. Seems like that would probably just get me more confused than necessary. I've hidden the treasuries from this just to make it a little easier to see. This is going to be much easier to do than their strategy MSTY covered call ETF. There's much fewer positions in this one. The fund is still pretty big. No, I'm sorry. I'm a one decimal. Oh no, this is only 6 million. Okay, so this is not that significant. So I started with the way that I usually go about these is I start hunting for the calls and the puts that form the synthetics. And let me back up. So when I covered the MSTY positions, I think most people... Okay, yeah, I think it is important that I cover what MSTY is doing, because options, everything in options is opposites. So if you buy a call, that's long. But if you buy a put, that's short. So if you're long a put, you're short the underlying. So you kind of have to get into this mode where you're like in math, when you took a negative times a negative and made a positive, you have to kind of get into that. And I, as a new options trader, figuring out this long and short language was the hardest fucking thing for me to do. I still kind of hate it and it pisses me off. And every once in a while, I kind of have to like go a little cross-eyed and remember that a negative times a negative is a positive. So MSTY, when they want to sell covered calls, they can't just buy 100 shares and then sell the covered call in it like any of us can and just make it easy mode, right? So what they do is, and I'm just going to go out 30 days. I forget exactly how far they go out on these. But the strikes, I don't know if they even matter, but they're going to buy a call and sell a put. Buying a call is long, selling a put is long. And if you pick the same strike and expiration dates, you're going to add the delta for the short put. That was 44. And the delta for the long call, that's 55. That's basically 99. Probably, if you add up the rest of these decimals, it adds up to 100. So that's going to give you a synthetic long position. Now you are justified. You can see people clown on Robinhood, but this little graphing feature is actually very nice. I mean, it's simple. It's not as detailed as some, but all you really need to do is see, okay, green and red, right? Okay, obviously this is long. As strategy's price goes up, if I, adopted this position, like, okay, cool. If strategy's price goes up, then this position would go up. And then if we said, okay, now we're going to sell a covered call against this synthetic position, then I'm just going to be super aggressive with this, right? I'm just going to collect $500 for this Friday. Now you can see that this is no longer an up and to the right line. Our upside is now capped. And so if strategy goes up to our strike, 380, then it just kind of stays pretty close to 380 forever. So unclicking the covered call, clicking the covered call, boom, now we've got a horizontal line. This is our maximum upside here. So remember all of that. And actually, let me just do one more thing. So if I wanted to cap my downside as well, right? Because now there's just kind of like, I want to say unlimited losses, but your maximum loss is, if strategy went to zero, would be the $37,700, right? But if I wanted to cap my downside on this position, then I could be like, all right, if strategy goes below 370, when I click this, we'll see a horizontal line appear here, because now I've capped my downside at 370. So this would be like, covered call strategy is a limited bullish strategy. We can't make profits above here, but also going ahead and buying the put would cap our downside as well. I never do this really because I don't really like buying insurance. But keep this in mind for when we start structuring and identifying the pieces in winter. And you got to kind of be like sleuthing this shit and kind of a little bit of an inspector here. I think the easiest thing to do is kind of look for the shares. If you can find shares that match up, they're probably related. And so with Misty, in order to form the synthetic position, the synthetic long position, we bought a call and sold a put. So if we're doing opposites, we have to sell a call and buy a put. And you can see here that they have the 380 calls and they sold 380 of them, right? So negative on the shares column is going to mean that they were short this position. So they're short 380. This is just an accident, I assume, unless that somebody just likes numerology and they liked 380 for some reason. What is 3 and 8 is 11, 1 and 1 is 2. So is there something significant about 380? Anyway, I think this is just random. But they have 380 strike calls. And then to form the other half of this synthetic short position, they also went long 380 strike puts. A long put is a short position. So these two positions form their synthetic. And let's just do the same damn thing. I'm not going to choose the same. Actually, I can just go out to, so that's July 18th. I might as well just, for the hell of it, let's just go out to July 18th. The 380s, right? So they're going to be short the 380 calls, buy put 380 calls, right? That's 49 delta on the long put and 50 delta on the short call. And let's check our little graph here. You can see that this is the complete opposite of that synthetic long position, and that we make money as the price goes down, but it's unlimited. And we lose money as the price goes up and it's unlimited. Yeah, so similar situation. YieldMax cannot hold shares of MSTR. And at the same way, what a normal covered put position would be is that they would short 100 shares of strategy, meaning that they would borrow them, immediately sell them, and then hope the price goes down, which I think is suicide for now. But regardless, since they can't actually literally short them, they have to do this synthetic short. And so, the delta on this is negative. So this adds up to 100, negative 100 delta. This is forming a synthetic short position on 100 shares. Then what did they do? Let me just I'm going to get rid of all of the green and white. Let's filter. Can I multi-select filter? No. Okay. Well, that sucks. Let me just change, let me change these to yellow then. All right, let's clear the filters. Okay, yellow forms the synthetics, and they have 380 short positions. So then I went looking for more 380s. The point of a short position, right, is selling them now, hoping that the price goes down, and then buying them back later. So keep that in the back of your mind, that in order to short something and be successful, the price has to go down, and your goal is to buy them back later at a cheaper price so that you can deliver them to the person that you borrowed them from, right? Because they are expecting their 100 shares. So in this strategy, the way that they actually earn their dividends is by selling puts. So you can see that they also have 380 short put positions, and they sold them and collected a bunch of premium. So that's the money making aspect, is this line item right here. However, and let's just go ahead and add that to the graph. So they sold the 377s, right? 7.3 sell put, and what you're going to see is another horizontal line here. Now we've capped our upside at the 377, right? If we're directionally correct, but it goes below 377, we've basically just capped our upside because we're willing to accept this premium up front. And that's what they're using to pay the dividends. But you can see here that we still have unlimited losses if the price goes up. And that would be a little bit too much risk, I think, for a covered call ETF to take, probably in any with any security, but let alone friggin' strategy, which could go nuclear. So I'm asking you to keep a lot of things in the back of your head, but also remember that this is a cash generating strategy. So if we're going to pay insurance to cap our downside if the price goes up, we have to pay less than we collected here, right? So the insurance has to be cheaper. So when we're buying a call to cap our upside, it's got to be at a higher strike. And let's see if that's true. Yeah, here we go. So here's another 380. These are all matching up pretty well together. And they went ahead and bought the 515 strikes. And let me check the date. Same date? No, the 718s. Okay, that's fine. Even better, because those are going to be even cheaper. So what did I say? 718? Yeah. All the way up here at the 518, 515 strikes. And now we'll see another horizontal line form capping. Whoops. Not selling a put, buying a call. So I was expecting more of a horizontal line. So I'm not sure if I made a mistake here or if it's because the expiration date for the 515 call doesn't match the put that they sold. So this is now a diagonal calendar spread instead of a straight. Let's see, do they have something that expires on 7/3? Doesn't look like it. So that was not the shape that I was expecting. That's kind of funny looking. Short call, long put. They shorted the put to collect premium, and then they're paying some insurance. So by buying this call, now the only thing is that since this call lasts 2 weeks, they're going to be able to sell 2 weekly 2 weekly puts in the same time frame that they paid for this. So this isn't gonna, I guess, demonstrate this exactly the way that I was hoping. But you can see that it's no longer a straight line down and to the right that leads to unlimited losses. Now it's kind of like rounded out. And this looks more like kind of like a y equals 1 over x graph where it gets infinitely close to a certain number and then never touches it. But keep in mind, since this is the puts that they're selling are only a week out, they're going to be able to sell like 2 of these. So let me just do I don't know if this is going to be right. Let's do 2 of these. Yeah, see, this is getting wonky as hell. Anyway, point is, this is no longer a straight line to the right, and they are capping their infinite losses by adding this long call. That gets us through the yellows and the orange. Those basically all match up, but here's where it starts to get even a little bit more difficult because they've got some strategies that overlap here. So I'm just going to hide all of those since we're done with them. I did the same thing. I found their short calls, 200 of them, and their long puts, 200 of these. And it's going to be the same deal. So they've got 200 of the 370. So let's set up our synthetic. So 377? No, 370. Selling a call, buying a put. Delta is negative 46. And negative 53. So adding up to basically 99, rounded off to 100. Oh, not 377, 370. There we go. And then, unfortunately, there's no 200 short puts here. We've got a couple of them. So it looks like they went ahead and sold 100 387.50 puts. And then they sold 160 of the 390s. But you'll see that they also set up 60 more positions. So I'm assuming that 60 of these positions are actually part of the white cells, and that the 100 387.50 puts and the 100 short 390 puts are the income generating portion of the green trades. And so I probably will need to, for this to make sense, I'll probably have to put the ratio in there, and I'll do 2. don't know if this is going to work. But the puts that they sold, we got 725. We got the 387.50s and the 390s. 725, 387.50s, 390s. 725. 390s. Oh, so these are European options. They must have 387.50s available to them. Unfortunately, I'm not going to be able to hit the 387.50s, so I'm just going to hit 385s, I guess. Actually, I might as well just say that they're all 390s and get rid of this stupid ass customs ratios. All right, so not going to be able to do this exactly, but you can see that this line is bending, so we're capping our profits by adding those short puts. And the last thing that we have to do is cap our upside losses with this 575 call. What's the date on that one? 7/18. You know what? Did I put the wrong date? 7/25? Oh, the 7/25 was on the short puts. Yeah, so some of this stuff, the expiration dates are not matching. So that's why we're going to get some curved lines in here. Capping our upside at 575. Oh, God. This graph looks crazy as shit. But the point is, we've got some horizontal green lines here where Winter would make some profits if strategy goes down. And if strategy runs up to 575, we're going to see some staggering losses, but then at some point that line gets clipped. And this long call, the profits from this long 575 call, if strategy went to like 650, 750, 1,000, whatever, would make sure that this fund does not suffer catastrophic losses here. And then I think we kind of see how this exercise is going. I don't think I really need to do the whites. It's going to be the exact same thing again, though. We would go to, yeah, see, they're not matching these up exactly either. So in this case, they're shorting the 400 strikes on the 15th, but they're longing the 400 puts for a different expiration date. So the deltas on this position, on these positions, will actually not exactly equal 100. It's probably close enough for government work, I suppose. And then the cash generating aspect are 60 of these 390 puts that they sold. And then they're capping their upside losses at 600, the 600 strike. So you combine, basically it looks like they've got 3 sets of synthetic shorts, 3 sets of short premiums against those synthetics, and then 3 sets of long calls capping their their financial anuses being ruined when strategy goes through the roof. So hopefully all of that made some sense. Now, with all of that being said, let's look at Winter's performance since inception. It opened up in April. So March. What was strategy in March? That was at the, holy shit. So they actually opened up this, huh? They opened up this fund right at the perfect time, didn't they? Shouldn't Winter have been printing money since strategy in March? No, I'm sorry. There was no. I'm sorry. I'm thinking 2024. Okay, so in March, strategy went up to 400 through May. Yeah, so that does make sense. So I'm sorry. I had still had March 2024 on the brain. So yeah, they opened this up and it like went up a little bit for April. So I don't know why it would have gone up. Maybe it just got popular for some reason. April 8th, that would have made sense. Yeah, that makes sense. So Winter topped out on April 8th when strategy bottomed. So that makes total sense. And then ever since strategy has been recovering from that correction, Winter's been taking it in the shorts. So it totally makes sense. I guess if you had bought in here and then you rebalanced and sold a bunch of Winter at the top, you would have made out okay, I suppose. And that's what, let's do MSTY. I guess that's what people are banking on. They're trying to pigeonhole themselves into like a traditional 60-40 bonds, 60-40 stocks to bonds portfolio, like the TradFi kind of thing. And they're like, okay, I'll be 60-40 or 70-30 long MSTY and short Winter and 30% of a Winter position. And then I'm assuming that you would rebalance. Let me do 3 months. I guess you would be rebalancing. I don't know. Do these people rebalance daily, weekly, quarterly? How much do you got to pay attention to this? But yeah, if strategy and Bitcoin continue to pump, Winter is just going to get absolutely destroyed. Now, if you are a 4-year cycle proponent and you think at some point in 2026 Bitcoin will be at like, whatever you think it's going to go to, 150, 250, 444, a million, and then we're going to see 2 years, 18 months to 2 years of a bear market. And I guess you're flipping your misty gains into Winter and then hoping to generate dividends with the covered put strategy on the way down. I just think it's one of those egghead things that makes sense if you think about it too much and you try to like say, okay, 60-40 has made sense, but now I'm going to swap in the new hotness into the old portfolio. I suppose. I guess I kind of did. I'm doing a little bit of that myself because I'm willing to short a portion of my portfolio in the short term, under 45 days in most cases, to go longer when I'm more certain of what the price will be in the future. But I think that the bet that I'm making is more mechanical. That the calls that I'm selling are a little bit overvalued because under 45 days because they do melt and decay so rapidly. And the long calls that are 180, 360 days out are undervalued because it's too hard to predict what the prices will be that far out. Whereas with the winter misty ratio, you're just basically saying what goes up must come down. And being, I don't know, it just seems like Misty is guaranteed to underperform strategy, and Winter is guaranteed to underperform shorting strategy in being right. And so you're combining two underperforming strategies just in the name of being diversified or playing both sides and hedged out. So, long story short, I prefer to do my own covered call selling. So I'm not advocating on Misty's behalf, and I don't think that I would ever just be truly short strategy. Like I might exit some positions and then move those profits into Tesla or something else that I had conviction in. But being short strategy under any conditions makes me nervous as shit. Because let's just look at Apple. I think, Saylor likes to talk about Apple. Like when Apple was, I don't know, $2 a share, and people were calling themselves a genius for buying it at $2 and selling it for $3 and getting a 50% profit, and then missing out on a 25,000% return. Now that took 20 years for that to happen, but it only took 10 years to 10x. And I see strategy doing, this graph looking like this, but maybe an order of magnitude higher than this. So trying to guess, like if I was going to own Apple and an inverse Apple and then try to rebalance, like when would that have made sense? Like it would have made sense from December 21st through December 2022. I'm sorry, December 2021 to December 2022. So like the inverse would have worked for a year and then you're fucked again. And then it wouldn't even have really worked here because this is just kind of like trading within a range. Yeah, I don't really see this working out. Like the fact that you're 70% Misty and Misty's based on strategy and strategy's based on Bitcoin, you probably outperform the S&P 500. Even taking the losses on winter, you probably still outperform the S&P 500. So like in that sense, I probably don't hate it, but it's almost just people like to diversify for the sake of diversification because of whatever that statistic is. Once you get 25 positions, you're insulated from, market anyone position hurting you or something, but not really. I'm not really buying it. So, Michael, let's see, Matthew Lindsley. For someone new to options, they are good. I like Thinkorswim to graph them out because you can step specific dates on your spreads, not just the expirations. Okay, good to know. Let's see. We've been talking about S&P 500 inclusion, but what happens if we have a net loss quarter? Won't they get kicked out? Yeah, I don't think it really works that way. It takes a lot more to get kicked out than it does to get kicked in. Yeah, there's no rule that says if they have negative EPS one quarter that they have to get kicked out. Especially by the time that happens, they would be so high up the leaderboard in the S&P 500 that it would be probably pretty hard to do. Matthew says they usually base it around consecutive performance. A single quarter won't kick them. Okay. Makes sense. Let's see. Well, if one were bearish strategy, you could just buy 3 months outputs at the 20 delta. That would be a cheap way to short. Yeah, exactly. If I wanted to just be short, I'd just be short. And it might be something fun to do. If strategy would hit like 2,000 a share, right? I'm kind of just half-assed guessing. The next time Bitcoin hits 150, strategy hits 1,000. Bitcoin corrects back down to 100, and then maybe they go up to 200. If Bitcoin hits 200, 250, then maybe strategy gets to 2,000. Some kind of like astronomical numbers like that. Like if strategy has to do another 10-to-1 split because they're at 2,000 a share again, that if I at that point, if I was like, you know what, I want to buy some insurance. How far did you say it? 3 months out. $20 delta. Yeah. Yeah, if I really just wanted some insurance, I guess I could buy these. But I can't imagine it. I can't imagine it before strategy just had an insane number before I would be willing to do something like this. And even if that happened, I would probably just be assuming, that's not going to work. I got my VPN on. And even if that did happen, if we get the next leg up to 1,000 or 2,000, I would assume that the IV rank is going to be staggeringly high, right? We're going to see a high implied vol at that point. And I don't really want to be buying puts in a high IV environment. I'd rather just load up and sell maybe a ton more covered calls. I could potentially be talked into like a debit spread. Because even in a high IV environment, if I'm buying the 300 and then I sold a put that was a little cheaper, I'd be paying more because of high IV for the put, but I'd be getting paid more for the high IV in the spread. So like a put debit spread, I suppose, in high IV would be more palatable to me than just buying the puts outright. But again, if I wanted to ensure that I locked in my profits, if strategy goes down, I think I would just take the damn profits and move my money into Tesla or something else that I had conviction in. Or hell, the preferreds. Just slam it into Strife or STRD if you're willing to take a little bit more risk. Yeah, that's kind of where I see myself. Is I have Tesla as my second best. So when I take profits in strategy, it'll probably be slammed into Tesla if Tesla hasn't also pumped. But if Tesla was cost prohibitive, then I'd probably just slam it all into Stride and kind of wait for the correction. Like strategy hits 1,000 and we get another correction to 500, then maybe I move back in, move my STRD back into strategy again. Something along those lines. Those are all kind of hypotheticals. I haven't formulated that plan exactly yet. And it will definitely depend on Tesla's price, right? If the market starts sniffing out profits with Cybercab and if strategy's at 1,000 a share and Tesla's at 800 a share or something by then maybe Tesla's not a good deal. But if strategy's at 1,000 a share and Tesla's still under 500, maybe I would be willing to rotate some profits into Tesla, anticipating some really, really impressive margins on Cybercab. All right. I hope that was more informative than confusing. Just kind of keep in mind that everything in options is opposites. So if you've got a synthetic long position, taking the exact opposite positions will create a synthetic short. And then with the covered call position, instead of selling the covered calls, you're going to sell the cash secured puts. And then for the long position, if you wanted to cap your downside, you would buy a put. And with the covered put position, if you want to cap your losses to the upside, you would buy an out of the money long call. So that's how it works. And thanks everybody.